Welcome back to the Risk Manager's Corner. In this episode, we're going deep into the core of quantitative risk modeling, the common univariate random variables that underpin almost every model we build in finance, insurance, and investment risk. Understanding these distributions isn't about memorizing equations. It's about knowing when to use each one, what assumptions lie beneath it, and how to interpret results correctly in the real world. Let's break it down one by one, from the simplest binary outcomes all the way to complex mixture distributions. Bernoulli and binomial distributions. Let's start at the foundation, the Bernoulli distribution. This is the simplest form of randomness you can model. It represents a single trial with only two outcomes, success or failure, 1 or 0, yes or no. It has one parameter, which we call p. That's just the probability of success. The expected value, or mean, is p. That's the proportion of times you expect success to occur in the long run. The variance, which measures uncertainty, is p multiplied by 1 minus p. In risk management, the Bernoulli model is everywhere. It's used to represent whether a single loan defaults, whether a client churns, or whether a policy claim occurs within a time period. Now, the binomial distribution simply extends this idea. Instead of one trial, you have n independent Bernoulli trials, each with the same probability of success. So if you're modeling, say, the number of defaults in a portfolio of 100 loans, each loan being a Bernoulli event, the total number of defaults follows a binomial distribution. Its mean is n times p, and its variance is n times p times 1 minus p. The binomial is your workhorse for count data where the number of trials is fixed, and each trial has the same success probability. It's widely used in credit risk, reliability analysis, and even stress testing when you're estimating loss frequencies. When the number of trials is large, and the success probability is moderate, you can use a normal approximation to simplify computations. But be careful. If p is very small or very large, or n is too low, the approximation will misstate tail risk. Poisson distribution. Next up, the Poisson distribution. If the binomial tracks a fixed number of attempts, the Poisson tracks how many events happen in a given time or space interval. It has a single parameter called lambda, which represents the average number of events expected in that interval. Here's the key. In a Poisson process, events occur randomly, independently, and the average rate stays constant. So if a bank averages 3 loan defaults per month, that's a Poisson process with lambda equal to 3. If you monitor customer complaints, system outages, or operational losses, all can often be approximated as Poisson counts. Both the mean and variance are equal to lambda, which makes it mathematically elegant and easy to work with. A practical property of the Poisson distribution is that it's additive. If you add together daily counts that follow a Poisson process, the total count for the week or month will also follow a Poisson distribution with the mean equal to the sum of daily averages. That makes it perfect for aggregate risk measurement and scaling over time. However, remember, Poisson assumes independent events and a constant rate. In real-world data, you'll often find over-dispersion, where variance is greater than the mean, a sign that events are clustered or influenced by hidden factors. In that case, you'd need to move toward a negative binomial model or a compound process. Uniform distribution. The uniform distribution is simple. It assumes every value between two limits is equally likely. You define it with a lower bound, called a, and an upper bound, called b. The average value is the midpoint between a and b, and the variance, or spread, depends on the width of that range. You'll use uniform distributions mostly for simulations, random sampling, and Monte Carlo testing when you want to generate unbiased random inputs. For example, if you're stress testing model outcomes under every possible interest rate within a range, Uniform randomness ensures you explore the full space evenly. But be careful. Don't use a uniform as a lazy default. If your data shows any concentration or trend within the range, you'll be ignoring valuable information about risk behavior. Normal distribution. Now, the classic, the normal distribution, also known as the Gaussian distribution. This is the single most important probability model in quantitative finance. It's defined by two parameters, the mean, called mu, and the variance, called sigma squared. It's perfectly symmetric around the mean, meaning outcomes above and below the mean are equally likely. About 68% of values fall within one standard deviation of the mean, 95% within two, and 99.7% within three. The reason the normal distribution dominates finance and risk management is the central limit theorem. That theorem tells us that when many small, independent random effects add up, their sum tends toward a normal distribution. That's why so many aggregated financial quantities, like total portfolio returns, behave approximately normal. However, and this is critical, real financial data almost always show fatter tails than the normal predicts. That means extreme losses or gains occur more often than a normal model would suggest. So, for day-to-day analytics, normals are fine. For tail risk, stress tests, or capital modeling, you must use alternatives like student T or mixture distributions to capture the extremes. Log-normal distribution. Now, the log-normal distribution. A variable follows a log-normal distribution when its logarithm, not the variable itself, follows a normal distribution. This ensures the variable always takes positive values and tends to be right-skewed, with many small outcomes and a few very large ones. This is exactly what we see with things like asset prices, wealth distributions, or insurance claim sizes, where losses or values can't go below zero, but can grow very large. If you model a stock price using geometric Brownian motion, the resulting price distribution is log-normal. Same goes for many risk factors that evolve multiplicatively rather than additively. A practical insight: the expected value of a log-normal variable is higher than the exponential of its average log value, because volatility increases the mean. This is often called the volatility drag, or Jensen's inequality effect. In short, if your variable is strictly positive and can fluctuate exponentially, the log normal is the natural choice. Chi-squared, student T, and F distributions. Let's group these three together. The chi-squared distribution arises when you square and sum a number of standard normal variables. It has one parameter, the degrees of freedom, which simply represents how many squared terms you summed. You'll encounter chi-squared distributions in statistical testing, especially when dealing with variances or model fit. For example, goodness of fit tests or confidence intervals around standard deviations. The student T distribution looks similar to the normal, but has heavier tails. It's also defined by degrees of freedom. When degrees of freedom are low, tails are fat, meaning more extreme outcomes are likely. As degrees of freedom increase, the T distribution gradually converges to the normal. In finance, the student T is essential when you're dealing with data that has outliers or limited samples. For example, short return histories or volatile asset classes. Then we have the F distribution, which is built as a ratio of two chi-squared variables, each divided by their degrees of freedom. It's mainly used in variance comparison tests and in evaluating multiple regression models. For instance, when checking whether a group of variables adds predictive power. Together, these three distributions form the backbone of hypothesis testing and statistical inference in risk modeling. Exponential distribution. The exponential distribution models the time between events. It has a single parameter, called beta, which controls both the mean and the variance. The mean is 1 divided by beta, and the variance is 1 divided by beta squared. The exponential is memoryless, meaning the probability of an event occurring in the next moment does not depend on how much time has already passed. This makes it a good model for waiting times in systems where events happen independently, like the time between incoming customer calls, machine failures, or claim submissions. However, in many real systems, events do cluster or depend on past history. For example, one failure increasing the chance of another. When that happens, you'll need to move to more flexible models like Weibull or gamma distributions. Beta distribution. The beta distribution is one of the most flexible models in probability theory. It describes outcomes that lie between 0 and 1, such as probabilities, percentages, or recovery rates. It has two shape parameters, called alpha and beta, which determine how peaked or skewed the distribution is. If alpha and beta are both 1, the beta distribution becomes uniform. If alpha is large and beta small, it skews toward 1. If beta is large and alpha small, it skews toward 0. This makes it perfect for modeling probabilities that evolve over time. For example, the probability of default, the proportion of a claim paid, or even model calibration uncertainty in Bayesian frameworks. In credit risk, beta distributions are often used to represent recovery rate assumptions, or the uncertainty in model parameters that take values between 0 and 1. Mixture distributions. Finally, the mixture distribution. This is where modeling starts to look more like the real world. A mixture distribution combines several component distributions, each representing a different regime or state of the world. For example, a normal market might produce moderate returns following one normal distribution, while a crisis market produces large losses following another. By combining the two with a small probability of the crisis state, you get a mixture that naturally produces heavy tails, even though each individual component is normal. This is one of the most practical ways to model regime switching behavior, structural breaks, or occasional outliers in financial data. However, mixtures are computationally heavier to estimate. You often need expectation, maximization algorithms, or simulation-based methods to fit them properly. The trade-off is worth it. Mixtures capture what most real-world data actually look like, mostly calm, occasionally chaotic. 5 practical rules for using distributions in risk. Number 1. Always match the model to the risk. If your exposure is sensitive to rare events, don't use a normal. Number 2. Approximations only work under the right conditions. Check sample sizes and parameters before applying them blindly. Number 3. Inspect your residuals. If they show skewness or fat tails, move to heavier-tailed alternatives like student T or a mixture model. Number 4. Simplicity is a strength, but only if validated. A simple model that works beats a complex one that doesn't generalize. And number 5. Test divisibility. When aggregating risk counts or losses, use models like Poisson or Normal that preserve structure when summed. Closing. These univariate distributions are the foundation of quantitative risk analysis. They power your Monte Carlo simulations, value-at-risk calculations, stress tests, and capital models. The key takeaway? Understand the assumptions behind each distribution, recognize their limits, and always test how they behave under extreme conditions. If your model underestimates rare losses, the fix isn't to increase confidence levels. It's to change the distribution. This is the Risk Manager's Corner, where we turn theory into practical, usable insight for financial professionals. Subscribe, stay sharp, stay data-driven, and manage risk like your institution depends on it. Because it does.